Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here's your weekly technical analysis of Chicago wheat and corn.
Chicago wheat. 3 weeks ago, the market exited up through the original upper trend line, currently at 635, perhaps for the last time, of, as I say, the original bear channel from October last year that had eventually morphed into a descending, expanding wedge pattern. I was never very happy with this pattern, but it was there after a fashion, and I utilized it when I could. It has recently been a controversial period. You see, the market was wrestling with two key supports, one of which is unique. They are the gap from July 2021 between 657.5 and 659.5, which despite 5 weeks of trying was still not filled. And a little higher up, the 50% absolute Fibonacci line at 682. This was why prices kept exiting, re-entering, and once again exiting the old descending, expanding wedge pattern. I previously said I've not been happy about this. As I previously said, I've not been happy about this wedge pattern, and I've downgraded it this time, as I threatened to do last week. The reason why is that these past few weeks, even with what looks like a possible base building going on, it still looks a little bit like, well, it looks like we may have a possible early November last year to date bearish halfway hesitation, which would have fitted in nicely the idea of a drop down to target X at 609, the original potential target for such a bearish halfway hesitation that I laid out some weeks ago. However, last week and also this week, the idea of a bearish halfway hesitation, whilst it is not completely ruled out, is very much on life support. We may instead be seeing a different pattern, a possible double, now a triple bottom formed over March, and now going into April. This continues to be a watch and see market. Please be aware that dropping down from above, we have the bearish pressures of the declining short medium moving average, currently 722, and the medium moving average, currently 741. Chicago corn. For many weeks here, this chart had been a headache to me, with so many things going on. However, 6 weeks ago, it all seemed to be settling into a pattern order. The ascending wedge pattern was the key pattern here, originating in November last year through to the end of February this year. I personally found this a very elegant pattern. Thus, at the end of February, the market punched down through the lower time, which is highlighted in green, of the July to December 2022 bullish shift pitchfork. This makes up the lower trend line of the descending wedge pattern. Thus, 5 weeks ago, we had a confirmed break lower, giving a primary target below of 661 and a harder to reach secondary target of 632. The same week as the break lower, the market reached the primary target. A week after, prices reached the secondary target. Now, you may think, well, that was enough, but no. There have been further developments. 3 developments, in fact. Firstly is a shambolic dead cross with the medium moving average, currently 651, down through the long moving average, currently 653. This has been going on now for quite a while, and though we are coming to a resolution, I am not that happy about this lagging indicator. Secondly, we had over the turn of the month from February into March a possible bear flag with a potential target in the 590 zone. I'll disregard this one after this commentary, as enough time and price movement has passed by to allow retirement of this target below. Thirdly and finally, we had seen the market drop down to the next key support and get stuck there for nearly 3 weeks before reacting higher 2 weeks ago. It has led to a revaluation of the purple lower time, currently 616, of the September 2021 to July 2022 bullish shift pitchfork. This pitchfork had never been previously tested on the downside, but the middle time above, currently up off the top of my daily chart, and managed to cap the market back in late September and October of last year. Hence, as I said 2 weeks ago, it deserved some respect. And it had thus proved to be true, as it has held up the market and stymied the opportunity to reach the potential bear flag target. It was again enough that, as I also said 2 weeks ago, there was enough to make a possible reactionary weekly key reversal up 3 weeks ago. Now, we had seen a follow-through higher 2 weeks ago, and at the start of last week, but 2 Mondays ago, saw a significant bearish pattern, a shooting star pattern, type 1, bearish, a pretty good follow through lower last week and at the start of Monday this week. It was only this past Monday's key reversal, ultimate key reversal up, that saw the low based on the lower time that stemmed the flow lower. But for how long? And for how much? You see, there has been a limited follow-on higher to that daily key reversal up during the rest of this week, and today we are back down to testing the Fibonacci congestion at 621 to 623. This may likely place the lower time back into the frame of the market, only this time we have a congestion zone below it formed during the middle of March between roughly 610 and 620. All I've got to add is just keep an eye on the moving averages dropping from above.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.